You
Yeah.
mentioned a lot of risk and return. I just wanted to pick up on another piece of information. So earlier this month, we heard that Apollo Global Management, which we do know very well here, especially LPGP, they got a 5.7 billion takeover of Pension Insurance Corporation, which is essentially a UK-based retirement saving group. Now, if we think about the next 10 years, British companies are expected to kind of offload about 400 billion in terms of retirement obligations. And of course, there is a whole set of assets, right, that backs them via risk transfer agreements, and so on. Now, my question to you is, how is this pace changing, and how is it reshaping the expectation exactly around this risk and return in the long term for the investor journey?
Yeah, definitely. If you look at Apollo Global, you have to look at that the spread of the products that they deal with as a fund. So most of the Apollo's transactions are private credit. So that is where they are very, very known for in the market. And if you look at KKR or whoever the other competitors is, which one's got that private equity versus private credit or private debt and all those. So the financial products in general is equity, debt, credit, and derivative. And how do the investor get into that fund is what defines the relationship between the LP and the GP, basically. Because if you're looking at a credit and a debt fund, definitely your specifics and your entries and exits are different because those funds could be open end versus closed end funds, right? You could raise the money all time, and or you can, most of the private equity funds are a closed end fund. Because you have a clear entry and a clear exit because you have to maintain the valuation at the exit, right? So from that standpoint, a pension fund, actively works on all the segments of investors. Basically, most of the larger investor group is also insurance companies, in this scenarios. So as they come in and start deploying that allocation, the risk gets diversified, but at the same time, the return gets minimized also. So the more you diversify the portfolio, the less the return is. Because if you look at any investment into equity product, directly people go into domestic equities or the international equities, and that is where you see your alpha coming into play. Now, setting up a multi-market, multi-asset portfolio, or even a multi-fund, where you can see there are portfolio companies that are on the innovation side. If you look at ARK Investment as a investment management company, most of the allocations are into disruptive innovation, the portfolio companies. So
Yeah.
definitely, it is, if you could define what fund they have, it is, it behaves like a VC, but it gives you a return more than anybody else sometimes, and it also has the larger risk, right?
Yeah.
So that's how this whole allocation changes when it comes to pension fund, because they seek uh, risk management from a different perspective. They would like to see multi-market, multi-asset, and fund as well, multi-return as well, in terms of how the fund behaves. So it's quite a challenging to construct a portfolio that has a multi-asset. When I say multi-asset, because the PE funds, what bring to the table is the dividend on time, which comes from the operating income. And that operating income needs to be sustainable until there is an exit date, which could be which could be 5 years, 7 years, 10 years, and you can extend it based on how your portfolio company's valuations are. So that is where the entry and the exit. When it comes to Apollo, they do huge transactions because their fund size is larger, the deal size is larger, is a bigger number, and at the same time, the deal counts go so fast because they tap into different industries, different sectors, and they switch gears between equity and credit. That is the key, the growth of Apollo at this point.
I think everything that you said, of course, it does make sense, and it leans, kind of paves the way